This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Joel Brightfield of 630 Ventures. Joel, thank you for joining us.
Thanks for having me, Hall.
Well, great. So can you tell us more about your background? What did you do before you started investing in early stage companies?
Sure, glad to. So career started in financial services, working as an investment consultant for institutional investors. So, large pension funds, endowments, foundations. Was in that role for about 8 years, and it really offered an interesting perch into how large asset owners think about venture capital fitting into their overall portfolios and how those investors, those large pension funds and endowments and corporates ultimately used technology to manage their investment portfolios and operations. It also offered a view into how the buy side, so all of the managers that these asset owners were allocating to, would use technology to manage their portfolios, or perhaps the lack thereof technology that was used throughout the asset management industry. And all of that really just piqued my interest into financial technology, and sort of had an interesting kind of view and an opportunity to kind of parlay that background and those perspectives into this role with 630, which is a early stage financial technology focused venture fund. We also invest in insurance technology and information security technology, but really my background playing most relevantly into the fintech investments that we do, and came on board with 630 about 4 years ago. And I guess, as they say, the rest is history.
Well, that's great. So what excites you right now?
Yeah, it's a interesting, crazy time, obviously. It's all a bit foggy right now, I would say. So we are, just like probably every other investor, trying to look through that fog and think about what the world looks like now and what that means for early stage venture investing. I guess if we think about what history suggests, it suggests that great companies are indeed born in times of crises. So, that's quite exciting to know that the entrepreneurs we're talking to, and more broadly, the entrepreneurs that are out there solving the problems of kind of this post-coronavirus world, are ones that we're going to look back on in 5, 6, 7 years from now and sort of have that sort of wonder about how we ever existed without these companies. And we're going to point back to their foundings as happening in kind of the immediate aftermath of this pandemic. So, that sort of environment in kind of a strange and odd way is quite exciting to us, and really motivates us to continue to do what we do and seek out really promising entrepreneurs solving the problems that we're faced with today.
Great. Well, you spend quite a bit of time investing in startups and other companies. And what's your advice for those who want to invest in early stage companies? What do you tell them to do before they write that first check?
Yep, great question. So given our focus in enterprise technology and specifically financial services technology and insurance, it's quite important that investors in this space really know the space. So it's complicated. There's a lot of specialization that has to go on. So simply trying to just be a kind of a passerby or tourist investor in the early stage enterprise tech world is difficult. You really need to have that focus and understand what it takes for an external piece of technology to be adopted by a bank and actually utilized by a brokerage firm, or make a difference at a large insurance carrier. So if this is a space that is of interest to you as an investor, I would encourage you to, really get focused and research it and understand what the problems are. And ultimately, when you do find compelling ideas and have done the due diligence on them, to really, really have that conviction behind them, because ultimately there's a ton of inertia around getting enterprise technology truly adopted at scale. A bank or an insurance company is very set in their ways. So adopting a new piece of technology to do a process differently is a big mountain to climb, and investors ultimately need to have that conviction that the given idea has the inertia to climb that mountain. So really focus, specialize, and conviction are a couple of things that come to mind for people that are interested in investing in this space.
Well, that's a good list there. So on the other side of that table, what do you tell people who are running startups? What should they do before they launch that business?
Yep. No, I think enterprise tech is hard, and enterprise tech in financial services is even harder. So understanding just the fact that it's hard, and what I mean by hard really is probably most succinctly the reality around sales cycles. So selling into a bank or another financial services company is a long process. It's not a bunch of quick hits. Sales cycles can be as long as 12, 18, 24 months for some of the largest contracts. And it's a complex organization to sell into. So having an appreciation for the enterprise sales cycle in financial services is important. And then maybe secondly and relatedly is managing the growth of your firm from a when do you hire and scale that sales team perspective to how much capital are you raising needs to be in sync with the reality of the sales cycles in the space. So do you have enough capital? Are you raising enough capital to withstand a 12, 15, 18-month sales cycle? Those sorts of things need to be in sync. And then ultimately, a last thing that comes to mind is unit economics. I think too often we see entrepreneurs in the enterprise tech space ignore unit economics because it's not exactly a concept that works in kind of that enterprise space, but it's important to not ignore it because ultimately you need to run efficient businesses and need to understand kind of what the capital is that goes into making each of those long sales and keep an eye on kind of operating in an efficient way. So ultimately it's quite rewarding once you kind of get all of these things to kind of work in sync, but it does take a lot of coordination across a couple of different facets of running a business to succeed in this space.
That's a good point. We always talk about unit economics being at the core of the business, and it's important to know what that is. And so that sounds like it's a good validation of that. So let's talk about the state of investing in startups. How do you see the industry evolving, and what changes do you see coming up?
Yep. So obviously the obvious headline here is the acceleration of digital transformations. I don't think that's necessarily a unique kind of point of evolution for financial services. I think that's sort of happening across every industry out there right now with the fallout of coronavirus. Really all corners of financial services are figuring out how to serve and remain viable in kind of a distributed manner right now. And there's been a lot of encouraging examples of sort of how the work over the past decade has really shined in these kind of weeks and months since we've fallen into this environment. But on the other hand, there's been a ton of frustrating examples of how the industry hasn't evolved as much as we thought it should have by now. So I think the most obvious example to look at is probably the mess of the PPP. The fact that the US government really didn't have a way to send small businesses a check is a big sort of blow to the financial technology world. The fact that small businesses have sort of had to scramble to find a banker that they know that could get them into the queue, and sort of that bank having to turn around and vet the business applying for the PPP with the SBA and then turn back around and sort of be that intermediary has just been extremely frustrating in my perspective. And from those that we've sort of portfolio companies that have had to go through the process and bankers we've talked to, it's been quite messy. And it just seems like financial technology could have really better served us all in this process. There's got to be a better way to get stimulus money in the hands of small businesses and citizens, and in this day and age of technology. So there's kind of a harsh reality of, kind of the state of the industry, but there's also a lot of positive examples to say that we have evolved quite a bit to date, but still a lot of work to do.
Do you think the COVID-19 economy is going to accelerate that shift to going online for fintech payments for the government?
Yeah, I mean, that's a big question, obviously. I think the short answer is yes. It should serve as that catalyst that we're probably going to need so that next it's inevitable that there will be another crisis and another need to sort of issue stimulus checks. And I can't imagine that we will not learn from this experience and not have a better way of distributing those funds when the time comes next.
Well, I remember back in January when the COVID-19 came out of Wuhan, China, there was a picture in one of the websites that showed a man sitting at a desk in Wuhan with stacks of cash all around the desk. And his job was to burn the cash because cash was spreading contagion. And I wondered if after this was over, would this speed up the move to digital currency in whatever form that might be? Because things that spread contagion are going to need to be eliminated and moving in that direction, albeit slowly. And would this be enough of an impetus to move us into that stage? Do you think that would happen?
Yeah, I do. I don't know if I necessarily place my bet on digital currency as much as just contactless payments. So things as crazy as, enabling a jacket or a piece of clothing to be payment enabled. We've seen a couple ideas that are doing just that, to be honest. And we think that the reaction here will be, more around how do we just eliminate contact in payment transactions. And if digital currencies are the answer, or they certainly are one way to do that, then so be it. But I think there's just a broader opportunity around moving every part of a transaction to a contactless form. And I think, that trend only gets accelerated with the COVID-19 fallout.
Right. Well, let's talk about the investment thesis for your fund. Can you tell us what the thesis is and what's your criteria for looking at startups?
Yeah, I'll probably answer this in kind of two ways. So one, in terms of just how we work, and secondly, kind of the thematic side of our thesis. So tackling the how we work side of the thesis first, SixThirty is an early stage venture fund in the sort of classic manner. And what we do is we really work with our capital partners very closely to understand what's relevant and what's going on at their bank or at their financial institution, and go out and find entrepreneurs building solutions that are relevant to their businesses and try to be the collision point for those two stakeholders, for that early stage startup that's building a piece of relevant technology to that bank or that insurance company. And alongside our venture fund, we run what we call our go-to-market program, which is an asset we make exclusively available to our portfolio companies and our limited partners. And it's a series of workshops and networking opportunities to bring the two stakeholders together and sort of work through the challenges of going to market that I alluded to as an enterprise tech company, and try to accelerate these portfolio companies' sort of path to commercialization in the space. So what we're looking for really at the end of the day are companies that are open to collaborating with incumbent financial institutions, open to partnering with them on a go-to-market basis, open to feedback and advice and coaching on how to fine-tune their value prop to what is really going to work at a financial institution. So that's the kind of how we work side of things. The thematic side of the thesis is probably best described by taking you through what we call our, kind of a perfect storm. This is a kind of a storm that we believe has been brewing for a couple of years in the market, and one that, kind of given our portfolio and our capital partners and our pipeline, we feel we have a fairly good perch to be observing on. And the storm that I'm referring to is really the convergence of our wealth and our health. So financial services and healthcare becoming increasingly connected. Just thinking about it, we are increasingly accountable for both our financial security and our medical outcomes. There's a ton of trends that suggest this. Just take a look at kind of the massive shift of a retirement savings world where it was a defined benefit scheme where you sort of were guaranteed some kind of financial security in retirement, to shifting that nearly entirely on individuals in the defined contribution world we live in, where that financial security in retirement is completely your own doing at this point. And similarly in healthcare, the shift to high deductible plans, and just the pace at which deductibles of growing has shifted more of the healthcare cost burden onto ourselves and away from employers. So it's really these fallout of these trends is creating this perfect storm of stress for individuals. And the stressors in our lives are our finances and our health. And on top of it, our personal information is increasingly vulnerable as the amount of data in these industries is, more and more of it is being produced as society grows. So I know this isn't the most sort of joyful picture to be painting, but the reality is that when a storm like this blows through, we have to clean it up. And we see a massive opportunity to do just that, and to invest in ideas that are addressing the convergence of our wealth and our health, and enabling enterprises to better serve their customers in a holistic way around their finances, their health, and their personal information. So that's kind of the gist of our thesis right now around this kind of perfect storm and the convergence of financial services and healthcare.
That's right. Problems require solutions, and people pay for solutions, and this is one they will definitely pay for. Can you talk about one or two startups that fit that thesis?
Yeah, it's probably ones that, kind of coming at it from a problem perspective, address either a cost problem or an access problem. And, maybe thinking of an example here, kind of a common occurrence in all of our lives. Take, for example, you get hit with an unexpected medical bill. Say you slipped and fell and you broke something and you had to go to the hospital, you ran up a hospital bill. We all know those aren't small bills, and your health insurance doesn't fully cover it. What does the average American that has $400 of savings do? He or she often raids their retirement account and takes penalties to access that money to turn around and pay off medical debt. So that's a very tangible example of the stressors that I spoke about, and just how connected our finances and our health are from a day-to-day perspective. So is there another way to cover that expense? We certainly think so. And we've seen a lot of startups think so as well, and think that there's a ton of opportunities to sort of tackle this negative feedback loop between our finances and our health. Is a startup theme that would fit that thesis, I would say.
Great. Very good. So you work with a lot of startups out there. What, aside from fundraising, what do you think the main challenge most startups face today?
Yep. A couple things come to mind. So really, our founding principles at SixThirty are around creating access for startups in the enterprise technology space. And what I mean by that is access to incumbents and the data that they have that can enable solutions, the subject matter expertise that they possess, and really ultimately the infrastructure that they've built up over decades. So as a startup, getting access to those things that incumbents ultimately are the gatekeepers of is a challenge that, we're trying to do our part in mitigating for startups by our model of bringing the two stakeholders together, incumbents as our investors and startups as the companies we invest in, and just making the access to those things a lot more easily accessible. And then it's things like I talked about earlier, the long sales cycle in our space in particular, and ultimately just getting true adoption of these solutions at the enterprise, at the incumbent enterprise level, I would say is also a challenge that I think that conviction point I made can help overcome.
Great. So you see a lot of applications in this space, fintech and insurtech. If you had to pick one or two key applications that are top of mind today, what would you put at the top of the list?
Yeah, a couple things come to mind. I mean, it's interesting to think about maybe subsectors within financial services that have maybe lagged other parts of the financial services world in terms of technology adoption. So two that come to mind are asset management and real estate. I would say these are two of the laggards in kind of adopting technology across financial services. So fees are only being compressed within asset management. So any opportunity to build applications around cutting costs and creating new revenue streams for the asset management industry is an area we're watching pretty closely. There's also, kind of moving on to a different thought, a lot of opportunity in kind of back office functions in banking, for example, that we think are kind of outdated in how they're completed, a lot of manual processes, a lot of human intervention. So building applications around things like KYC and AML and financial crime oversight, we think are sort of areas that traditional lenders should take notice to and perhaps turn to startups to help kind of bring those processes to a more modern kind of approach in the market these days.
Well, those are good ones to review. So in the last few minutes that we have here today, what else should we cover that we haven't?
Yep, great question. And maybe the one thing that's coming to mind would be just some of the, sharing some of the advice that we've been talking to CEOs and founders in our portfolio about in terms of navigating the market environment that we find ourselves in. So a couple of things that we've been out there talking to our founders about are things that are probably rather intuitive, but somewhat important to hammer home. So one, giving founders and CEOs the encouragement to act decisively. So there's really not a lot of time as a startup to mull over decisions about how to cut expenses and what to focus on. And you need to act decisively to make a lot of tough decisions right now to stabilize a business that really just the nature of being a startup doesn't have a ton of slack in it. Other things are shoring up cash. So again, making tough decisions around where to cut expenses. If you're, lucky enough to be faced with opportunities to take on capital, don't think twice about that. Take the capital if it's there. Extend your runway as much as possible. We've got a saying at our firm about, protecting the churn in a time like this. So we're talking to our founders about focusing on existing relationships, prevent as much as you can any non-renewals with contracts. In terms of new opportunities, really focus on upselling with current relationships. I don't think you're going to be able to start relationships from scratch in this point of the market. So really kind of this idea of protecting the churn is a point of advice that we're out there with our founders on. And then just when you have the time, think about how your value prop, what you offer ultimately needs to be fine-tuned for the reality of what is kind of being regarded as the next normal. At some point, we're going to kind of get back to something that resembles normalcy. And we want our portfolio founders to be thinking about what their businesses need to look like to be ready to pounce on that moment.
Well, that's great. So how best for listeners to get back in touch with you?
Yeah, I'm an email guy. So shoot me an email at joel@sixthirty.co, spelled out 630. Is probably the best way. I'm up on LinkedIn as well, so you can find me there as well.
Great. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Awesome. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.